I want you to look at the chart on your screen right now. Don't look at the price. Look at the line. Look at that huge vertical spike shooting up from the top of the candle. That isn't just a line. That's a crime scene. Silver flashed to $83.71. It didn't crawl there. It teleported. One moment we were trading at $79. The next moment, $83. And then, just as fast, the floor was pulled out. The price collapsed from $83.71 all the way down to $74.47, a $9 swing in a single trading session. If you're a new investor, this probably scared the hell out of you. You saw that drop and thought the rally was over. You thought the bubble had finally burst. But if you're a veteran, if you lived through 1980 and 2011, you know exactly what just happened. This was a stop hunt, a calculated algorithmic attack designed to wipe out leveraged traders who chased the Sunday night gap. The banks saw liquidity drying up during Ghost Week. They saw an empty order book. So they let the price run to $83 to pull in retail money. And once the trap was full, they slammed the door shut. In this emergency market analysis, we're going to break down the anatomy of that $9 move. We're going to examine the shooting star candle forming on the daily chart. We're going to explain why this level of volatility is actually healthy for the long-term trend, even if it feels like a heart attack right now. And most importantly, we're going to show you why the physical price of silver did not fall $9 today. The paper market is whipping around like a flag in a hurricane, but the flagpole hasn't moved. This is the story of the Monday rug pull. To understand why silver dropped from $83, you first have to understand who was buying at $83. It wasn't smart money. Smart money bought at $30. They bought at $50. The buyers at $83 during the Sunday night gap were the chasers, the fear of missing out crowd, the traders using 10 times leverage because they wanted to get rich fast. The banks have the data. They know exactly where those traders place their stop-loss orders. A stop-loss is an automatic sell order that triggers when price falls. Most traders who bought near $80 placed their stops around $75, so the drop was engineered. The banks dumped a massive block of futures contracts at the top. That pushed price lower, $79, then $78, and then straight into the stop-loss zone at $75. Snap. Thousands of retail sell orders fired at once. The result was a cascade, a waterfall of forced selling. Price plunged to $74.47 purely because of liquidations. And who was waiting at $74 to buy it back? The same banks that sold at $83. They sold high. They forced you to sell low. And then they bought your position back at a discount. This process is called rinsing the leverage. It's brutal. It's unfair, but it's how the market clears out the gamblers before the next leg higher begins. Now let's look at the chart pattern itself. From a technical perspective, this candle is known as a shooting star, sometimes called a high wave candle. It has a small body and a very long upper wick. That wick represents rejection. It shows that the market attempted to push silver up to $83, but sellers forced it back down. Typically, a shooting star signals a pause. It suggests the buyers are exhausted. They sprinted uphill and ran out of breath. That means we should expect consolidation here. Price may chop sideways between $75 and $80 for several days. Do not expect another straight vertical move tomorrow. The market needs time to digest a $9 move. But here's the critical data point. Look at where we closed relative to last Friday. Friday's close was $71.91. Right now, silver is trading around $78.36. Despite the violent pullback from the highs, we are still higher, nearly 10% above last week's close. If you ignore the wick, if you ignore the brief flash to $83, this was still a massive green day. The trend is still up. The breakout is still intact. The only thing that changed is that the easy money phase is over. Now we move into the volatile grind. Now let's talk about gold. Gold is trading around $4,514, down only about $4. That is stability. While silver is whipping around like a wild animal, gold is sitting calmly at all-time highs. That tells us the monetary system is still broken. Gold is the anchor. As long as gold holds above $4,500, the floor under silver is secure. Silver is simply behaving like the high beta sibling. It overshoots on the way up, and it overshoots on the way down. That volatility is the price of admission. If you want silver's upside, you have to endure silver's swings. If today's drop to $74 made you panic, you were over-leveraged. Physical holders didn't panic. Physical holders looked at the screen, saw the drop, and went back to eating leftovers. Because an ounce is still an ounce. Now we need to talk about the ghost week factor again. We warned you that low volume creates air pockets. Today was the proof. The reason silver was able to fall $9 so easily is because there were no buyers in the middle. The order book was hollow. Price fell straight through the gap until it hit the limit buy orders from the industrial whales sitting at $75. Notice exactly where the bounce happened, $74.47. Why there? Because $75 was last week's breakout level. Old resistance became new support. The market tested that breakout, and it held. That is technically perfect behavior. It confirmed the $75 floor. The whales were already waiting. They stepped in aggressively, buying the dip and pushing the price back towards $78. This confirms the industrial bid is real. Samsung and Tesla did not chase silver at $83. They are too smart for that. They waited. They let the banks smash the price, and then they scooped up cheap contracts at $74. Smart money buys weakness. Dumb money buys strength. Today was a clean transfer of wealth from weak hands to strong hands. We're going to take this investigation further. We need to look at the physical market reaction. Did dealers lower prices when spot dropped to $74, or did they keep premiums high? And we need to examine the January setup. Does this shooting star candle damage the January effect, or does it simply create a better entry for pension funds? The rug pull was painful, but it cleared the deck. The leverage is gone. The weak hands are gone. Now the real market can resume. Stay tuned as we continue this deep dive. We're going to check the pulse of the physical supply chain. Do not let the volatility shake you out. Now we need to talk about the physical disconnect. While the paper price was collapsing from $83 down to $74, what was happening at the coin shops? Did dealers slash their prices by $9? Did they say, the futures market crashed, let's sell silver cheap? No. They kept prices exactly where they were. In some cases, they even raised premiums. This is the single most important signal for physical investors. The spot price collapsed, but the street price held firm. Why? Because dealers know the paper volatility is artificial. They know that if they sell a silver eagle at $78 and the price snaps back to $83 an hour later, they lose money. They are not willing to play the volatility game with their physical inventory. They treat physical silver as a stable store of value and the paper price as a broken casino. So if you were waiting to buy physical silver at $74, you probably missed it. That window was open for maybe 15 minutes. And even then, most websites were likely crashing or showing out of stock. This proves the dip was a paper event, not a physical one. There was no flood of physical selling. There was no line of people dumping bars. There was only a computer algorithm dumping futures contracts. This divergence matters. In a real bear market, physical holders panic and sell. In a manufactured stop hunt, physical holders do nothing. What we saw today was holding. We saw strength. The foundation of this market is solid concrete, even if the roof is shaking in the wind. Now let's look at the industrial reaction. Imagine you are the procurement manager for a solar company. You need silver. You have a budget. You saw the price spike to $83 this morning, and it terrified you. Then you watched the price collapse to $74. Did you panic? No. You celebrated. You immediately hit the buy button on your hedging software. That $9 drop was a gift to industry. It allowed manufacturers to lock in inventory at a discount before year end. They used the bank's manipulation against the banks themselves. The banks smashed the price to flush out speculators, but in doing so, they handed industrial users a cheap entry point. That is why the price snapped back so aggressively from $74 to $78. Industry stepped in. They absorbed the paper selling and converted it into physical delivery demand. This created a higher low. Last week, the floor was $65. This week, the floor looks closer to $74. We are building a staircase. The steps are getting steeper, but the direction has not changed. Up. Now let's talk about the volatility tax. Volatility is a tax on leverage. If you were trading futures, options, or margin today, you paid that tax. You got wiped out. But if you held physical metal, you paid nothing. An ounce is still an ounce. In fact, you gained information. You now know the market is capable of reaching $83. You have seen the potential. That flash to $83 was a glimpse of the future, a preview of true price discovery when suppression briefly loosens. Think of it like holding a beach ball underwater. For a moment, the grip slipped and the ball shot up to $83. Then the banks forced it back down to $78. But now we know how much energy is stored in that ball. $83 is not the ceiling. It is just the first stop. Now we need to look at the currency crosses. Silver did not just crash against the dollar today, it crashed against everything and then recovered against everything. Meanwhile, the dollar index itself remained relatively flat. That tells us this move was not macro-driven. It was not about interest rates. It was not about geopolitics. It was not about a policy announcement. This was an internal market event. Positions were simply too crowded on the long side. The boat tipped over. Everyone fell out. And now the boat is floating again. This kind of cleanse is actually bullish for January. If silver had gone straight to $100 without a correction, the eventual crash would have been devastating. It would have ended the bull run for years. By flushing leverage now, by resetting open interest now, the market clears the runway for new money coming in January. And that new money, the pension funds we have talked about, they are happy. They did not want to buy at $83. They are far more comfortable buying at $78. Today's move made the market more attractive to institutional capital. Now let's talk about the psychology of the wick. That long upper wick on the chart is intimidating. It represents rejection. Technically, it means sellers overpowered buyers at $83. That creates a resistance zone. For the next few days, $83 will be difficult to break. Traders who bought the top are now bag holders. When price revisits $83, many of them will sell just to break even. That creates overhead supply. So do not expect an immediate breakout to $85. We need to work through that supply. We need consolidation. We need sideways trade between $75 and $80. We need time for the moving averages to catch up. This sideways chop is the hardest market to trade. It is designed to bore you. Volatility fades, excitement disappears, and that is usually when the next major move begins. But there is a wild card: gold. Gold is still trading around $4,514. It did not flash crash. It did not spike. It simply held. That stability matters. If silver's bull run were truly over, gold would have collapsed as well. The fact that gold is holding above $4,500 tells us the monetary premium is still intact. Silver just got ahead of itself. It ran too fast. Gold is the adult in the room saying, "Slow down, we are going higher, but not that fast." Now look at the gold to silver ratio. At $83 silver, the ratio dropped into the 50s. At $74, it jumped back towards 60. Now at $78, it sits around 57. The ratio is compressing, and the trend is still downward. That means silver is still outperforming gold. Even on a crash day, silver is stronger than it was a week ago. Last week, we were celebrating $65. Today, people are disappointed with $78. That shift in perspective is the wealth effect at work. You are frustrated, you are not getting rich faster, but you are still winning. Now, let's talk again about the bank solvency rumor. We mentioned the possibility of a Lehman-style moment. Did a bank actually break today? A move of nearly 10% suggests that someone was under serious stress. The crash from $83 may have been the forced liquidation of a long fund that became too aggressive, or it may have been a desperate short attack by a bank trying to defend the $80 level. If it was a bank defending $80, they burned a huge amount of ammunition. They dumped massive paper contracts to push the price down by $9, adding even more to their short exposure. They bought themselves one more day, but they made the next rally far more explosive. They kicked the can down the road, but the can is getting heavier. Now look at the volume profile of the move. The volume on the way up was massive. The volume on the way down was also high, but it was panic-driven. Panic selling rarely lasts long. It burns itself out quickly. Structural buying, on the other hand, can last for months. The buying we saw at the open and the buying we saw at the lows was structural. The selling was tactical. And over time, structural buying always beats tactical selling. So what is the strategy for the rest of Ghost Week? We have only a few trading days left before New Year's Eve. Liquidity will remain thin. What happened today can happen again. We could see a flash move down to $70, or just as easily a flash move up to $85. Without the adults in the room, the market behaves like a random walk. Your job is to stay out of the crossfire. Do not place stop-loss orders in this environment. If you had a stop at $74, you were taken out today. You sold the exact bottom, and now you are watching price trade $4 higher. That pain is intentional. The only way to avoid it is to remove stop losses, trade small enough that you do not need them, or hold physical metal, where stop losses do not exist. Now, we need to focus on the monthly and yearly close. Wednesday is December 31st. The month closes, the year closes. If silver closes the month above $75, it will be the highest monthly close in history. That will print a massive green candle on the yearly chart, and that signal will go straight to the pension funds preparing for 2026. Even with a long wick, even with rejection at $83, a close near $78 is a victory. It locks in the January effect. Do not let intraday violence blind you to the inter-year trend. Volatility is the noise. Price level is the signal. We are trading near $80. If someone told you that 1 month ago, you would have said they were crazy. Now you are disappointed it is not $90. That is progress. In the next section, we will look closely at the January setup. We will analyze how algorithms interpret this shooting star candle. Does it scare them away, or does it look like a discount? We will also walk through the year-end checklist. What you need to do before Wednesday to be ready for the rollover. The rug pull was a test. You passed. Now it is time to graduate. Now we need to step inside the mind of the machine. Modern financial markets are dominated by algorithms, specifically commodity trading advisors. These systems control hundreds of billions of dollars, and right now they are staring at that shooting star candle on the daily chart and recalculating risk. To a human, a shooting star looks like failure. It looks like price tried to fly and got slapped down. But to an algorithm, it looks like volatility. And algorithms hate volatility. When a market swings $9 in a single day, risk metrics explode. The machine reads that as instability. Position sizes must be reduced. So over the next 48 hours, the algorithms are unlikely to buy aggressively. They step back. They let price drift. That creates the chop zone. Expect silver to bounce between $75 and $80 like a ping pong ball. Up $2, down $2, up $1, down $3. This chop is designed to destroy option traders. It drains time value from call options. It frustrates momentum traders who want instant gratification. It is the spin cycle of the washing machine, clearing out excess leverage before the clothes come out clean. But here is the key insight. Algorithms are short-term thinkers. They focus on daily volatility. Pension funds, the capital arriving in January, are long-term thinkers. They focus on monthly trends, and the monthly trend is vertical. When a pension fund manager looks at today's drop, he does not see a shooting star. He sees a discount. He sees silver trading earlier at $83 and now available at $78. That is $5 saved per ounce on a $1 billion allocation. That is a win. Ironically, the rug pull increases the probability of the January effect. If silver had stayed at $83, institutions might have hesitated. It would have looked extended. At $78, it looks attractive relative to the high. The crash cleared the runway. The heavy jets can land. Now, let us talk about the monthly close. Today is Monday, December 29th. We have 2 trading days left in both the month and the year. Wednesday, December 31st, is the deadline. For technical analysts, the monthly candle matters more than anything else. If silver closes the month above $75, it will be the highest monthly close in history. That single candle will engulf more than 10 years of price action. That signal overwhelms daily volatility. It tells long-term trend followers that the bear market is mathematically over. It signals the beginning of a secular bull market, cycles that last 10 to 15 years. Those markets do not care about a $9 drop on a Monday, so the battle is simple. Bulls must hold $75. Bears must push price below $70. Right now, trading near $78, the bulls have a $3 buffer. They are winning. All they have to do now is run out the clock until New Year's Eve. Now let's look at miner psychology. Imagine you are the chief executive of a major silver producer, Hecla, First Majestic, one of the big names. You watched silver spike to $83 today. Did you rush to sell your production into the market? No. You saw the volatility. You saw the manipulation. And you understood that the market is broken. When a market is broken, producers stop trusting the exchange. They stop selling forward. They stop hedging. They hold the metal. What we are likely seeing right now is a seller strike from the mining industry. Miners are effectively saying, we will not sell our silver into a volatile, manipulated casino. We will wait until prices stabilize at much higher levels. That removes supply from the market at exactly the moment the banks need it most. Banks can smash the price to try to cover their shorts, but they can only cover if someone is willing to sell to them. If miners are not selling and long-term holders are not selling, then who did the banks buy from today? They bought from leveraged speculators who were forced out. The weak hands. Once those weak hands are gone, only strong hands remain. And strong hands do not sell at $78. That brings us to physical inventory. This week, we need to watch the exchange inventory reports closely. In a normal market, a price crash sends metal back into the vault. Sellers panic. Inventory rises. But watch what happens now. I expect to see inventory outflows, even on a crash day. Why? Because industrial buyers, Samsung, Tesla, and the major solar manufacturers used the dip to take delivery. They saw a $9 drop and said, "Thank you, we will take 10 tons." That means physical metal is leaving the vault while the paper price is falling. That is a bullish divergence. It tells you the price is lying. The shortage is getting worse, not better. Now add geopolitics to the equation. The world is unstable. There are tensions in the Middle East, tensions in the South China Sea. Silver is a war metal, not just because it goes into missiles, but because it has no counterparty risk. If conflict erupts, stock markets can close, bond markets can freeze, banks can fail, but metal in a vault remains wealth. Ghost Week is when smart money hedges against year-end risk. What happens if something breaks on January 1st? What happens if a currency is devalued? capital moves into silver as a bunker. That safe haven demand puts a floor under the price. It prevents deep crashes. People would rather hold silver at $78 than hold cash that could turn into nothing if a bank fails. Finally, let's talk about the unit bias shift. At $83, silver is no longer seen as cheap. It is becoming a precious metal again. That changes buyer psychology. The bargain hunters leave, momentum traders arrive, and most importantly, asset allocators arrive. When silver was $20, it was too small for large funds. At $80, the market capitalization has roughly quadrupled. It is now large enough for hedge funds to enter without breaking the market. Higher prices attract larger capital. This is the reflexivity loop. Rising prices change the fundamentals, which then justify even higher prices. The crash from $83 was painful to watch, but it was necessary. It flushed out tourist money. It allowed institutional capital to step in, and it set the stage for the monthly close. As we move into Tuesday and Wednesday, expect chop. Expect banks to try to pin the price below $80 into year-end. But trends behave like rivers. You can build a dam, but if the water keeps rising, the dam eventually breaks. And the water is rising. We are closing out the most volatile day of the year. This is the final chapter of this emergency broadcast. We have dissected the flash smash that took silver from $83 down to $74 and then back to $78. We exposed the stop hunts. We analyzed the bank stress. We examined the strength of the physical market. And now, many of you are looking at portfolios that feel like a battlefield. Today's volatility was enough to make even seasoned traders feel sick. But if you are still here, if you did not sell the bottom, you are a survivor. And in a bull market, survival always comes before profits. In this final breakdown, we are going to run through the year-end checklist. We have 48 hours left in the trading year. This is how you prepare for the final closing bell of 2025. This is the final verdict on the shooting star candle. And this is the mindset you need as we head into January. The storm has passed. The ship is still floating. Now it is time to set the course. Item 1. Audit your leverage. If today's $9 swing made you feel physically ill, you are carrying too much leverage, too much margin, too many options. Use the next 2 days to de-risk. Reduce paper exposure. Shift toward physical metal or fully paid mining shares. January volatility will be even higher. You want to be in a position where a $10 drop does not force you to sell. Item 2. Watch the $75 line. This is your line in the sand. Today's bounce from $74.47 confirmed $75 as the new hard deck. As long as price stays above it, the breakout remains intact. If we dip into that zone again, it is an opportunity. If we break decisively below it, we reassess. For now, $75 is the fortress. Item 3. Ignore intraday noise. For the next 2 days, volume will be thin. Algorithms will print strange candles. Spreads will widen. Do not stare at the screen all day. Set alerts and step away. Chop exists to steal your attention and your capital. Now let's deliver the final verdict on the shooting star. Technical textbooks will tell you a shooting star is bearish. They will say it marks a top, but context matters. A shooting star at the end of an exhausted trend is dangerous. A shooting star at the beginning of a breakout, created by a low-volume holiday vacuum, is often just a speed bump. What we saw today was not a reversal. It was a liquidity test. The market tested $83 and found sellers. It tested $74 and found buyers. Now the market knows the range. We will trade inside that range until new money arrives in January. Do not let a single daily candle scare you out of a yearly trend. The daily chart is noise. The weekly chart is powerful. The monthly chart is monumental. We are days away from 2026. If 2025 was the year silver woke up, 2026 is the year silver goes to work again, as a monetary metal and as a strategic reserve asset. The January setup is nearly perfect. Leverage has been flushed. A high floor has been established. Gold is holding above $4,500. And a wall of pension capital is waiting to enter. I believe $83 will be taken out within the first 2 weeks of January. That wick is not a ceiling. It is a target. Markets love to fill wicks. Price will return to that zone to see if sellers are still there. Next time, they will not be. They sold today. We are looking at a clear path toward $100. Whether it happens in the first quarter or the second quarter, the trajectory is locked in. The physics of supply and demand demand it. So here's the conclusion. Today was scary, by design. If this were easy, everyone would be rich. Markets force you to earn your gains by enduring volatility. You endured it. You held the line at $74. You are still standing at $78. You passed the test. The year is almost over. You are positioned in one of the few asset classes that protects against debt collapse while benefiting from the global energy transition. The hard part is done. Now let the January effect do the heavy lifting. Enjoy the new year. Keep your stack safe and get ready. Because if you thought today was wild, wait until the real money shows up. The rug pull failed. The trend is intact. The bull is alive, and it is angry. Subscribe.